Let's take a look here and try to find the relationship between the balance sheet and the income statement and define what's on each one of them. Now the balance sheet would have assets equals liabilities plus stockholders' equity. Now the income statement is actually the net income for the year or the period. Now that net income flows back to the balance sheet and is accumulated in retained earnings. Okay, let's look a little further here at the assets. The assets are broken down to current assets and long-term assets and contra assets. Also shown here on this template would be the T account for each one of these accounts. Like in the case of the assets here, I got the debits as a plus and the credits as a minus. So debit increases it, credit reduces current assets, and it's the same for all of them here on this template, except that the debits and credits are shown as plus and minuses. It's kind of handy. It's a good reference. So assets are what the company owns. That's what it owns. And let's come over here to liabilities. I just broke it down here by current liabilities, long-term liabilities, and then contra liabilities. Liabilities are what the company owes. Taking a look here at stockholders' equity. Broken it down by contributed capital, which would be the common stock, preferred stock, additional paid-in capital, and treasury stock. And again, debits and credits are shown here as plus or minuses and pluses. Minuses for debits, pluses for credits, and of course treasury stock is kind of a contra account. So that would be debits plus, credit minus. Now, contributed capital is what the owners have contributed to the company. Looking here at the earned capital, which would be retained earnings, the dividends, and other comprehensive income. Earned capital is what the company has earned and reinvested in itself. Now looking over here to the far right, we got the net income under the income statement, and I broke it down by revenues, expenses, and cost of goods sold. In the income statement shows how much the company earned during the period. Now remember, these totals here under revenues and expenses, they get summed up and they go into an income summary account, which we'll look at, and then it gets transferred over to retained earnings. Here I just show the balance sheet side of the equation, and we get again assets equal liabilities plus stockholders equity, and then broke it down, and assets are an investing activity, and then liabilities and stockholders equity are financing activities. So the balance sheet is a record of what the company has and how it came about having it. So it's really a snapshot, as you've probably heard, in time at a particular date for the assets, liabilities, and capital. These accounts here in the balance sheet, they aren't zeroed out at the end of the period. They're accumulated. As long as the company's in business, they get accumulated here as debits and credits, and they're defined in that fashion. Okay, the income statement, which is net income, I have it broken down here. That's your operating activities for the company. The income statement answers the questions: where did we make or lose money? This is why the incomes and expenses are grouped. Here we got all different accounts, but I've just shown some basic breakdown here. Outside customer related transactions will end up as part of the income statement, with the other side of the transaction affecting the balance sheet. So they're going to be balanced there. The fundamental question: did the business generate money? That is the question that the income statement will answer. And just looking here, this is just a basic overview, but you get all these assets and liability accounts that are accumulated during the year, and what happens when there's charges from those accounts are sent over here and they flow into the income statement. So for example, you debit an asset here, you may be crediting a revenue here, but whatever activity, operating activity is going on, it goes into the net income. And then at the end of the year, end of the period, all these accounts here are sent over to the income summary accounts where they're summarized, and then the net amount flows into retained earnings under stockholders' equity. So what started out here in assets and liabilities get transferred over to net income. They flow back over into the balance sheet where they're accumulated. Okay, just brief view here. We'll look at, for example, how we transfer those over. We got revenues, they flow, get closed to the income summary, and then the income summary gets closed over here to retained earnings. And then same for expenses. They get closed out here, and they flow into the income summary, and they would be transferred over into retained earnings. Now, this income summary account actually summarizes all the net income accounts. For example, the $1,000 that we had a credit here would get credited to income summary, and our expense accounts would be debited or decrease the income summary account. And then that net amount, the net amount is summarized here, and then it gets transferred over to retained earnings. So we don't really bring all the debits and credits over to retained earnings. We just summarize them and bring one amount over from the income statement. So we either have a gain here or a loss here, and the income statement are transferred each period to the income summary, and the income summary is transferred each period to the retained earnings. All these accounts here are what they call temporary accounts. And just to look here, when at the end, after they get closed out, you can see here they're all zeroed out. All these accounts are zero, and they start over fresh each year. And then when they get transferred to the income summary accounts get zeroed out, and they get transferred over to retained earnings. So this is just a brief overview of a template here that shows the balance sheet, the income statement, and just a rough description of what's going on between these two the balance sheet and the income statement. Just to understand here, the balance sheet accounts are accumulative. They're not zeroed out. They're not reset. But that's just whatever's going on in the company. That's what the balance sheet is for the company at any point in time. Whereas your net income accounts here, they get zeroed out at the end of the year, and they go through the income summary, and then they get put into retained earnings. So if you got gain or net income plus income, so you'd get a credit here to retained earnings, and if you'd have a loss for the period, you get a debit here, reduce retained earnings. That's about what these two statements are, the balance sheet and the income statement.